In this video, we are going to get a little bit deeper into actual trade strategy. So if you have not looked and reviewed the prior videos on how to trade crypto, please go back and do that first because these videos will build upon each other. In our last video, we talked about support and resistance and how important they are to trading. Today, I wanted to spend some time talking about technical indicators. So there's kind of a myth out there in the trading world, and people just love it. They just eat technical trading indicators. They um, they like to use them because it makes them look smart. They kind of market them as this is the ultimate method, and they like to show you all the successes that they're having with technical trading indicators. Well, on the Coinbase YouTube channel that if any of you followed very long, you'll notice that I don't use a lot of technical indicators. And the funny thing is if I was to take the thousands of technical indicators that exist out there, I could boil down those thousand into two trading strategies. And so this is what will really blow your mind. You can actually be successful with almost any trading strategy. It all depends on how much you enter, what you do when things go against you, and your position size and what coin you're trading. So the technical indicator is actually less important than you think. What it really comes down to is, are you consistent? Are you have you tested your strategy to make sure that it's profitable? And when things go against you, what's your backup plan? So we'll talk a little bit more about some of that in other videos, but I wanted to kind of dispel some of the myths out there, because some people will have this amazing trading strategy. They're like, oh, I've got this super secret trading strategy, and you need to pay me $10,000 for my lesson or my class or something else, and I'm gonna reveal these secret indicators that tell all and do all. But in actual fact, everyone may have a different twist, but everyone's doing the same two things. Okay, the first school of thought is, when the price goes really high, I'm going to have a set way of saying I'm selling. I'm going to sell it as it spikes up, and when it spikes down, I'm going to buy. And so what the people will do, and I'm going to show you an example here with BAT, so basic attention token, and I'm going to use the RSI. It's probably one of the most famous indicators for overbought and oversold. And so people that get into this indicator will tell you, look, we just barely broke above 70 on the RSI. We are going to sell right here, and it's a perfect trade. And then the price goes down. And then they wait, and they wait, and they wait, and they wait. And then on this day right here, we broke below the 30. So we're going to buy. This is the absolute top. This is the absolute bottom. What a heroic trade. We did the perfect trade. We bought here, we go all the way up, and then here we are. The second we spike up, we're above the 70, we sell. And then what happens? We wait. First, here we go. We're out. We're down below the 30. Now we sell. We've made so much money. We sold here, we bought here, we're catching tops, we're catching bottoms, everything's beautiful. And then right here, we exited another day right up here, just the perfect trade. And so this goes on, and then right here, you buy. And then what happens to the price? Oh, that's weird. What happened to our perfect trading system? Now we're selling off like crazy. But we're in over here. We just bought right here. Holy crap, we're down 60%. Okay, finally we're above the 70. Sell. Okay, so we lost 50%. All right, well, let's wait for our next buy. I guess we're this is where we are. But anyway, you can see that there are flaws to these strategies. Just because something works perfectly, it doesn't mean that it's going to be the end all be all and catch all. Everything can go wrong. And so, yeah, you're right. I mean, you can make a good point that, all right, well, then you need to mix something else in. Well, why didn't you mix something else in back here? Like, why didn't we, you have to be consistent. So whatever you're testing and whatever you're trying to do, we need to make sure that we're doing it consistently. And traders are really bad at looking at a little bit of history and saying, this has worked for so long. I'm going all in here, and I'm going all out here, and I'm going all in here, and then all of a sudden, they undo all of their progress because they are because they get into an upside down situation. But a lot of these trade strategies, they take advantage of these spikes up and spikes down, and that's the entire trading strategy. So what happens if we spike up here and we sell, and then we keep going up? This trade strategy may not be as profitable as we once thought it was. And so there are challenges with trading. Depending on how you play it and how you limit your risk and your reward, you can make your way through some of this. But if you're doubling down and doubling down and doubling down, things can get a little scary there. But especially if you're trading with 100% of your portfolio or doing other things, these trading indicators may lull you into a false sense of security. So the other school of thought is looking at trends. And as you know, watching my channel, I like to trade trends a little bit better, a little bit more. You may not trade the exact tops and the very exact bottoms, but looking at a trend will usually catch these giant moves. And the giant moves can be more profitable. So in my personal trading opinion, I prefer the second method, which is using trends. So we've gone over the Kelvin moving averages in the past. But the idea behind trends is that you may not hit every perfect trade, and you may not get all these little oscillations all over the place. But in general terms, when you're looking at the long-term strategy, the main direction of a coin, you're going to catch these giant moves, these giant swings. But yeah, you'll miss out on some of these. But from a longer term and more risk averse method, I'd rather keep things a little bit more in check. So there are plenty of different indicators that will look for trends, but this indicator that I've shared publicly is just one that I have had a lot of success with, and it's something that will help people that are newer to trading to stop making so many trades. Like a lot of people, they get into trading and they want to buy and sell every day. But what you really want to do is be placing a trade per year or every couple of months because that's where you can capture the bigger swings. So this particular strategy just says, hey, the 50-day moving average is very, very important. I'll go back a little bit here. And all it says is that if we are in a situation where we begin trading above the 50, then we are likely to see a trend reversal where the trend is heading up. If we break below the 50, that could happen at any point here, but as long as we get below the 50 and we stay there, our trend is generally going to be heading down. When we get back above the 50, our trend is back up. And so by doing this, you don't capture these exact highs, and you can use other methods to try to capture some of these. But the idea is that the longer term movements will generate more profit for you. But I'm not really trying to sell you on either method. I'm just showing you that there are pros and cons to either. And my personal trading preference is to look at these longer term trends. I'd rather go with the trend is your friend psychology than try to capture different spikes up or down, because a lot of times you can leave a ton on the table, or one bad unidirectional move will just totally wreck your portfolio. But anyway, the general consensus is, hey, we're down below the 50, it's time to exit. And then you normally see a pretty good trend reversal. We're down below the 50, down below the 50. Okay, we're finally above the 50. And you can see that these long-term monthly trend changes are pretty darn profitable. You can make a lot of money using just these basic indicators. So, there are times though where you'll get whipsawed. We're below, we're above, we're below, we're above. So everything comes down to position size and where you decide to exit. But this is sort of something that I'll leave up to your own personal interpretation. But the fact is, once we finally get above that 50, we're in good shape. And when we're down below, there's usually a trend there. So I get excited about when we've been on one side of the 50 for a long time and we switch sides. I get very excited about it because generally those are really awesome long-term trend changes. So I hope that this makes sense to you, and I hope that you don't get too confused with all the millions of indicators and all of the talking heads out there that try to show how smart they are with 1,000 things going on their chart, and then they're trying to convince you to give them money or to do something when their trade strategy is not going to be that much better than the next guy's. It all comes down to position size, the amount of risk you're putting in, and what you do when things go wrong.